Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Tuesday, July 11th, 2023, and I am pre-recording this Trading Places Live for a little bit later this morning. Futures currently are positive. We've got the Dow Jones Industrial Average up 46, S&P 500 up 9, NASDAQ futures up 40. So on a percentage basis, NASDAQ showing a little bit more strength. Crude oil prices up another 50 cents a barrel. We're at $73.50 per barrel. And the U.S. 10-year Treasury yield looks like maybe a little gap down this morning. Right now, down about 4 basis points, 3.97%. That could be a significant topping signal on the 10-year Treasury yield, and we'll talk about that in just a little bit. Let's go ahead and talk about the agenda for today. So we're going to start off with the daily market recap, jump into talking technically. Got a chart of the day for you, kind of a chart you've probably seen quite a bit of, but I'm going to take a little different spin on it. What's hot, what's not. Got some areas there that you want to keep on your radar, maybe keep off of your radar. Earnings spotlight, and then we'll wrap up with the 3 you must see. So let's go ahead and get going. Got a lot on the schedule. I do want to first point everyone over to earningsbeats.com. And the reason is we're starting a new live trading room on Wednesdays for our members. If you'd like to be a part of it, you can join with a 30-day free trial. So as you scroll down a little bit, you'll see it here in the middle of our home page. If you click on this register now button, it'll take you to a page where you can sign up for a 30-day trial. Or if you'd like to just give us a shot for a year, there will be an option to go ahead and sign up and pay as well. But all you need to do is be a free 30-day trial member to come in and check out our trading room. This will be on Wednesday. We'll start at 10 a.m. Eastern, so about a half hour after the market opens. We're going to run it for about 45 minutes, and I'm going to talk a little bit about managing risk, optimizing strategies, and looking at doing some real-time trades, show you a little bit about how we use our scanning strategies to try to identify high reward to high risk candidates, or high reward to low risk candidates. We don't want the high risk. Sometimes there are trades you can't really help it. If you want big returns, a lot of times you have to be willing to take that risk. But the idea is to try to manage that risk, try to make it skewed more towards the winning side. And if you are wrong, hopefully be able to keep those losses small. So we'll talk about that. Also, I plan to discuss some of the things that would maybe change my mind about this market. As you know, I've been very bullish really for over the last year. I think that the long side has been the way to go. I think I've been proven correct. But what could be that fly in the ointment? I mean, where could we be running into trouble? I don't see it happening, but I'm at least keeping it in the back of my mind in the event that we do start to see things begin to change. There are a couple of things that really maybe keep me up at night a little bit. We'll talk about those tomorrow during the live trading session as well. So anyhow, if you'd like to sign up, go over to earningsbeats.com. Make sure you click on this register now button. We would love to have you. If you just want to learn a little bit more about Earnings Beats, we do have a free Earnings Beats Digest newsletter. Talk about this again in just a little bit when we do the chart of the day, but name, email address, all it takes there. Hit that subscribe button. We'll get you started. Let's jump into the daily market recap. So what happened on Monday? Well, we had the Dow Jones Industrial Average gain over 200 points. The S&P 500 was up 10. NASDAQ was up 8. Mid caps up 32. Small caps up 15. Transports up 160. So when you look across the board, the areas that I just pointed out that gained more than 1%, mid caps up 1.25%, small caps up 1.3%, and transports just continue to soar, up another 1%, now above 15,700, clearly making a breakout of its recent downtrend. That bodes so well for the S&P 500 going forward. If you know anything about history, if you follow my show, you know that when transports break out, that is a very, very bullish sign for the S&P 500. Moving on to sectors and individual healthcare, also strong, up 0.8%, of 1%, and energy right about 0.8%. So not the best groups. I mean, we're not seeing technology, we're not seeing consumer discretionary, we're not seeing communication services, but we're also not seeing consumer staples and utilities. There is a little element of defense in there, and that we do have healthcare, but we've got one of the aggressive groups, although clearly not among the most aggressive, in industrials, leading this market to the upside. I find this to be bullish. Healthcare, again, that's a little bit more defensive. Biotechs, though, which are a more aggressive area within healthcare, biotech started to move yesterday. We're going to keep an eye on that because July tends to be a very good month for biotechs. It had not been a good month through the first week of July, but picking up yesterday, so that'll be worth watching. Energy, in terms of gaining 0.8%, trying to make that breakout up around the 82 level. That's what I'm watching. From an industry group perspective, industrial machinery, part of that industrial sector, bouncing off 20-day moving average, moving back up. Looks to me like it's ready for a breakout. Airlines just don't seem to stop. We're just continuing moving up. This is a nonstop flight from the lows to the highs, and no signs of coming back down just yet. So continue to watch the airlines. We did get a downgrade this morning on JetBlue. Don't know how much that will impact the group, but I think JetBlue was down a couple percent in the pre-market. So we'll see if that has any impact. But other than, we really just haven't seen much in the way of selling on the airlines. Transportation stocks, that's what I was talking about there. Look at this. I mean, the transports, and we show it up here, but I just wanted to point it out again because this kind of a move we don't see very often, and it is extremely bullish for the overall market. All right, let's move on to the 10-year Treasury yield. So here is what could be an island cluster. And of course, if you gap down, leaving that on an island, that could be a top. Here we had a top. It was just a island reversal. There was no cluster. It was just one candle. If you get more than one candle, it's considered a cluster, where you gap up and then you trade sideways and then you gap down and you leave this cluster of candles on an island. And if you look back up here, this was an example of what one looks like beginning in November, this top. So we'd gone back down, we rose, and on the heels of this rise, we had a gap up, traded sideways, in this case, 5 candles, and then we gapped down. And notice that started a move to the downside. Well, this morning, as I had mentioned in the lead up to the show, U.S. 10-year Treasury yield right now down a little bit more than 3 basis points, 3.97%. That looks like we're going to get a gap down. And unless we rally back today, if we continue to move lower on the yield off of the open, or at least as far as stock charts is considered, that open, that would be potentially a reversing candle. And it comes at an interesting time because we had just gotten up to 410. And if you look, 410, that's where we had gotten to in March. And here we are again, right to that 410 level. And now potentially putting in an island cluster reversal, similar to the island reversal that we saw back in March. So it doesn't mean that even if you see this and we do have a downtrend, doesn't mean we're going back down to 280. I mean, we literally could just go back down, maybe hit the 20-day or even the 50 down near these recent lows. Maybe we get as low as 370 potentially. But that's at least worth monitoring, because unless you can break back up and get back up into this cluster, that would be a topping signal. S&P 500, moving on to talking technically. Here you can see we do still have that negative divergence, lower PPO, higher price. We've pulled back. We're near the 20-day. We're up a little bit pre-market this morning. I would watch that 20, because if we lose the 20, I think that increases the odds of a 50-day test, given the negative divergence that's in play. So we'll continue to watch that. As long as we hold the 20, I'm okay. And honestly, sometimes these negative divergences don't play out. You go sideways for a little bit, and then we take off again, and that PPO soars. I know when you look back, you say, well, that hasn't been the case over the last year. Remember, though, that was a bear market. That was a cyclical bear market. PPO doesn't behave the same in a bull market as it does in a bear market. If you want to see the PPO and how you can ignore negative divergences, you should probably go back into maybe 2021 or 2020 after the pandemic, or even back in the 2016, 2017, 2018 timeframe when we were in uptrends. They don't always pan out. And it's hard for me personally, it's very difficult to bet against a bull market. And I believe we're resuming one. So I think the right idea is, when you start to see a little bit of maybe cautiousness like this, is instead of getting into leveraged ETFs that track the S&P 500, just the spider's fine. For me, you're still making money. If market goes up 2%, if the S&P goes up 2%, you make 2%. If it does sell off, and let's say it goes down 4%, you go down 4%. But that would be the time, at the 50-day or close to the 50-day, that would be the time to be thinking about leverage on the spider. Same goes for the NASDAQ 100. So let me go ahead and pull that up for you. Here, I showed it yesterday's show, and I've shown it recently. If you use a line chart, you can see that we clearly have higher closes with this negative divergence. We've been kind of going down testing, but holding the 20-day. We've got futures up today. We do have a big inflation report tomorrow. Now, I think the CPI is expected to come in 0.3% higher. And if we strip out food and energy and we look at the core, we're also expected to rise 0.3%. On Thursday, we have the PPI. Those numbers are expected to rise 0.2% on both the headline and the core level. I mean, if we got a number that was maybe 0.4 on CPI or 0.3 on the headline, or even on the core number on the PPI, something like that maybe could spook the market in the near term. So next couple of days, we do have some big inflation reports that obviously the Fed will be watching closely. So, but if those numbers come in below expectations, I wouldn't rule out another big rally. So I think there's a little bit more risk in the air. And that's why I've been saying, maybe a little less in terms of leverage. I mean, if you want to leverage, what I've been looking at is small caps, biotechs. Small caps have been going sideways. I think we could see rotation. If we do see a sell-off in the NASDAQ or in the S&P 500, that money very easily could move into the small cap area. That's what happened yesterday. Biotech, same thing. It's a group that's been beaten down that loves the month of July. So if I was thinking leveraged ETFs, those are groups I would be looking at rather than the S&P and the NASDAQ. That's just me. It's about trying to evaluate risk. And right now, it's just a little too risky in those two areas with that negative divergence to be thinking about, juicing up, trying to juice up my returns. Closer we get to the 50-day, though, if we do have some weakness, that would all change for me. All right, small caps, big day yesterday, up 1.71 on the Russell 2000. And we are right up against this resistance level. And I noticed in pre-market, we pull up that IWM. Right now, we're at 188.40. We're up about 0.3% this morning. So that 188.40 takes us pretty close to these highs. I think we did get up to about 189.25 back in June. So let's watch that level. But I think we're going to go through. I don't know if it's today, but I do think we're going to go through and probably make a run toward this double top up here between 198 and maybe 200. 198, 199 is really, that's the highs that we had. So I'm a little bit more bullish in the short term. Maybe, I don't know if I'm more bullish the IWM. I'm very bullish the S&P and the NASDAQ. But I do recognize those negative divergences. And if you look at this and you say, well, hey, we have equal highs and lower PPO here, we have negative divergence. This is a little different to me for a couple of reasons. Number one, we do not have a negative divergence if you look at closes. We have not had a higher close than we had back on June 13th. So that would suggest to me that we probably still have potentially some more room to the upside. Also, we've come back down since that first high on the PPO, and we've come back down near the 180 level twice. which is getting closer and closer to the 50-day. The other two have not come below the 22 or the 20-day moving average. So the S&P and the NASDAQ continue to trade up above, and they continue to try and push higher with signs of potential slowing momentum. Here, the IWM's actually come back, and we're not too far from the center line. So I don't really see a lot of negative divergence or slowing momentum when we really haven't had a lot of momentum to begin with. So that's the way I look at the IWM, and that's why not really worried about PPOs. In fact, if we get a breakout, I think you're going to see this PPO turn up pretty quickly, and there will be no negative divergence. That's how I think it develops. We'll see. All right, chart of the day. So anytime talk about the chart of the day, I want to just take you over to earnings beats, because if you like the chart of the day, then you are probably going to love our Earnings Beats Digest newsletter, because 3 times a week, that's exactly what we provide. A chart that we think is worthy of mentioning for one of a number of reasons. Could be a number of reasons, but one of those probably triggered the reason for putting this chart in as the chart of the day. And a lot of times I look at earnings, I look at gaps, I look at relative strength, I look at seasonality, I look at sentiment, could go on and on. The PPO, the RSI, candlesticks, price volume. I mean, all of those things factor in. And so usually it's going to be one of those topics that I'll write about. And it's a very quick, easy read. 2 paragraphs in a chart. That's all it is. Name and an email address is all it takes to subscribe. There's no credit card required. You can unsubscribe at any time. You're not going to hurt my feelings. We do this to give back to the community. If you're not finding any value from it, I have no problems. Unsubscribe. Maybe you're more long-term. I mean, I do put some charts in here I think that would interest long-term investors, but for the most part, I would say it's more appealing to those of you who short-term trade, either day trade or maybe swing trade over a few weeks to a month, that kind of a thing, maybe a couple months. That's really what these charts are going to focus on, but give that a shot. See if that helps in your trading. Hopefully it would, maybe add to some of the things that you already use in your trading. Maybe just, 1 or 2 little concepts maybe could really improve your results. So make sure you check that out. All right. So for the chart of the day today, I've got the S&P 500. You might say, well, why? We talk about this all the time. Well, I've got a little different perspective on it here. So I have a weekly chart going back 50 years. And what I did at the bottom is I put a 260-week rate of change. And the reason I did that, 260 weeks, is 5 years. And I just want you to see, because I think perspective is so important in the stock market. And, I always chuckle. I mean, I chuckle to myself, but I find it sad sometimes. Whenever I go and I see that Jeremy Grantham has posted another bubble video about the S&P 500, or Peter Schiff. I mean, these are 2, perma bears. Always got all these reasons why the stock market's going to collapse. And then when it does actually go into a bear market, they are geniuses. Once every 5 or 10 years, they're geniuses. The other 9 years out of 10, well, we won't talk about that. Let's just talk about when they were a genius. And that's what happens when you're a perma bear. If you call, you're crying wolf all the time, eventually you're going to be a genius. The market's going to go down at some point. You're going to be right. But in the meantime, while you're calling all of these awful things and market Armageddon, we just keep pushing to new all-time highs. So the answer is not to listen to folks who are always bearish, because they are wrong way more than they're right. Way more than they're right. Just ignore them. You know what? And when someone is always bullish, and you might think I am not always bullish. I'll call it like I see it. But if you got somebody who's just always bullish, you've never heard them say anything bearish, they're going to be right more than those perma bears, but still, you're going to miss the boat on some key tops. So I'm not going to say you ignore them, but just understand where they're coming from. Always bullish, always bullish. Market's always going higher. And if you think I'm like that, you need to go back and read all of my articles from the first 6 months of 2022. Go back and watch all my YouTube videos from the first 6 months of 2022 and the end of 2021, by the way, because at the top, I was calling for, I would caution is what I started calling for. I was just like, okay, we got some problems. They could trigger some selling. And then once the selling triggered, it was a full-on cyclical bear market. But look at this chart and look at down here at the 5-year rate of change. Now, a lot of folks are saying, oh my gosh, this is like 1999 and 2000. Well, in 2000, the 5-year rate of change on the S&P 500 was 220%, which was about a 40% per year average return. 40% a year for 5 years. That's how bubbles are born. I want you to look at where we are right now. Last 5 years, we're up 57%. Does that sound like a bubble? We've averaged a little more than 11% per year for the last 5 years. That's not much more than the average return since the 1920s. The average return since the 1920s is 9%. We're up 11% over the last 5 years. Okay, maybe we're a little ahead of ourselves, but that's what happens in secular bull markets. That's not a bubble. Look at where we stand right now versus where we have stood over the last 50 years when we look at a 5-year rate of change. We're at 57%. If you go back earlier and, maybe within the last 10 years, we've had readings down in the, around 30% to 40%. And then with the pandemic, because of the huge drop, we actually went back down to about 10% 5-year return at the very low. But that's kind of unusual, just like up here at around 170%. 2014, that was coming from the 2009 low. That was a little crazy. When you come out of the first 5, 6, 7 years coming out of a bear market, a secular bear market, you're going to see moves like this to the upside. And the reason you're going to see moves like this to the upside is because we were so oversold during the secular bear market. So it happened here when you 1975, by the time we got the first 5 years of or 7 years of the secular bull market, you can see we were up over 200%. Here we got up 170%. That's what you're going to get when you're coming off a major low. Now, probably in 2025, when we get out here and we go 5 years from this pandemic, I think there's a chance we could be up here in the 100, 120% range. I would not be surprised. Maybe more than that. Probably more than that. Because 100% would only be from 2,200 be 4,400. That's about where we are right now. So I think we're going to see a pretty big 5-year return off of that. It's chance we're going to be up 200% because we were so low. I actually think we probably could be maybe back this 180. I don't know. We'll see. But we're going to rise probably because 5 years from 2020 pandemic low, it's going to put us in March of 2025. By the time we get there, this will probably be up pretty substantially. And you know what? At that point, we'll probably come back down a little and things will begin to slow again. Maybe we'll have another cyclical bear market. Anyway, just wanted to point that out. All right, what's hot and what's not? So first, I wanted to start off with what's not. And I pulled up the TAN to show you just renewable energy and the fact, this is a little bit more diversified than, say, the $DWCREE, which is the Dow Jones U.S. Renewable Energy Index. This one's a little bit more diversified. And you can just see it's just not been good. We've just continued to move lower and lower and lower. We did see a nice move yesterday. We'll see if that maybe can jumpstart the group short term, but just hasn't been a very good group, right? And then let's take a look at something like footwear. So footwear, look at it relative to the S&P 500. It's been dropping for over 2 months. We're now on an absolute basis pretty close to, year-to-date low was beginning of June. We're almost there. Not good when the market's been going up. And then also not strong is the healthcare group. Healthcare, look at this. Down near kind of like a quintuple bottom. something like that. A couple bottoms in March, another one in May, another one in June, and here we are, not far from that bottom again. Is this group ever going to get going? We got United Healthcare reporting, or United Health Group reporting on Friday, I believe. And so we'll see maybe if that can jumpstart the group. But, part of the problem with this group going down has been United Health Group. It gapped down back earlier in June. The whole group gapped down. And healthcare, you can see, trying to rally back from it, but struggling. What has been hot? Well, definitely autos. I did mention JetBlue was downgraded this morning, but look at the autos. Look at the relative strength over the past couple of months. Autos versus the S&P 500. Look at that AD line. Very, very strong. And even after a really big move, not really selling off much. And it goes beyond Tesla. If you've looked at Rivian, Rivian's been on absolute fire. I had posted about that, the daily market report, probably 3-4 weeks ago, talking about how it looked like a bottoming head and shoulder pattern. We needed to get through $15. Well, once we got through 15, we did the next 10 pretty easily. I think we're up $25 or something like that now on Rivian. But even some of the smaller ones, Lucid's been on fire. We've seen, let's see, I think one of the top mover, NIO. Yeah, NIO had a big jump yesterday in the scooter. I mean, pull up that, another breakout there. So there's been a lot of movement to the upside. And let's get this. Yeah, so you can see this has been a weak, NIO's been a weak performer versus the autos, but the autos have been so strong. Look at this bottoming head and shoulder pattern, just making the breakout with increasing volume. And I'll show you that Rivian chart. Here was that move down. Here was the head. Here was that neckline coming across. Actually, it was 16. My bad. I thought it was 15, but it was at 16. And look at this move going through 16. Now we're trading at 25.51. Look at the volume. Look at the AD line soaring. Relative strength all of a sudden soaring. Autos have been hot. I think that's pretty clear. All right, earnings spotlight. Just want to mention a couple stocks here. SGH, Smart Global. This is a semiconductor. They reported back at the end of June, got a nice gap up. They've pulled back to hit support, but this is a stock that beat revenues, $383 million versus $375 million, crushed earnings, 66 cents versus 40 cents, and got that big gap up. Look at this. Here's your pre-earnings run. So the earnings come out spectacular, and right now, after about 6 days, we're up maybe 75 cents from where we were when we closed before earnings. Here's Wall Street jumping in. That's why you want to follow a stock heading into its earnings in terms of trying to figure out how it's going to perform with earnings. Because SGH now for the last 3 months has been trending higher versus semis. Semis have been awesome versus the S&P 500. You got a hot stock within a hot industry group. I would be expecting earnings beat, which we got. In this case, we did follow it up a little gap up. But sometimes you get the pre-earnings move, which is your buy on rumor, and then you get your sell on the news. You gap up, and then you sell off with the news. Not unusual at all. So a couple of earnings to watch this week. I think Cintas is going to be a pretty decent one. It had been going up relative to its peers for quite a while. It's pulled back recently, but mostly it's been sideways consolidating. I think this is going to be a pretty good report here. I think also, actually, let's just make this, we need to wrap up. Let's just make this one of the three you must see. So let's look at Cintas here, which I think is going to probably show some nice strength. Also, JPMorgan. JPMorgan, I know the banks have not been doing well, but here is your leader. If the leader doesn't come through with good numbers, then I would probably write off the majority of banks. JPMorgan has been a great performer. You can see that AD line's been strong. It just recently broke to new highs. Volume, I could like to have seen a little bit more volume. We did get a little bit on this breakout, but not a lot. But banks have been so weak. Here's one of your leaders. What does JPM have to say on Friday? That's going to be big. And then one more. I'll give you one that did report just this week. This is Helen of Troy, HELE. Absolutely blew numbers out. Bottom line was expected to be $1.60, and it came in at $1.94. Easy beat. HELE revenues $475 million, expecting $465 million. Look at the volume, look at the gap up, easily clearing resistance. I suspect we might pull back a little bit, but my suspicion is that we're going to see higher prices on Helen of Troy. All right. That's it for me. I appreciate everybody tuning in. Again, I do want to mention tomorrow, Wednesday, you can see our show over at Earnings Beats at 9 o'clock. Just go into our regular show by clicking on Trading Places Live right here, and that'll give you the link to come in and listen to our show tomorrow at 9 a.m. That's a free show, always. But the live trading room is for members only, and that will start at 10 a.m. tomorrow morning. So make sure you sign up for at least a free 30-day trial. You can do that here, start your no-cost trial, or you can do it here by clicking on that register now. We'd love to have you. I think you'll find our trading room fascinating. Our members have loved. We've done a couple of full-day trading rooms, 2 of them in the last couple quarters. We'll probably have another one of those coming up pretty soon. This is just going to be, a little mini trading room compared to that, but we'll do about 45 minutes, and I think give you a lot of really good information, things to look at when the market opens, and also potentially some live trades that I'll put on, just depending on how things set up. And it could be a big day too, because the CPI comes out in the morning. Anyway, have a great day, everybody. Happy trading.